Good afternoon, everyone. Thank you for attending the first webinar of 2020 from WTT. My name is Rhys Thomas. I'm joined with WTT's Head of Tax, Tom Wallace.
Afternoon, everyone.
This afternoon. Briefly explain, I'm the Managing Director of WTT, both tax and legal companies. And we'll be going through today a very short calendar for contracting industry, exploring some of the key dates, key events that we consider to be important to contractors over the coming year. Bear in mind that whilst WTT is perhaps best known for its work with contractors in unpicking the past, a lot of our work focuses on the future and management of IR35, etc. So not everyone on this webinar will be affected by all of the provisions. So we won't be going into particular detail, but those who have seen our webinar schedule for the year will know that we include more specific webinars over the course of the next quarter. So we'll get going with what we're going to be looking at today. Is a short summary of who WTT are for the purposes of people who aren't clients on the call. We are, for all intents and purposes, tax, legal and wealth advisors, advising on all ranges of areas, most well known for our work in the contracting industry perhaps, but we advise on a lot of wider principles of tax, and both historic and looking forward into planning. So considerations over the course of this year and what we'll discuss today are the loan charge. That's a big one for the contracting industry. Interplaying with that is the 2018-19 tax return. Brexit will have a big effect on the contracting industry. We anticipate the budget announcement for 2020 will also have some provisions. Clearly IR35 extensions into the private sector and the ongoing IR35 review will also have big implications for the contracting industry, and we'll touch on at the end there entrepreneurs relief and questions around that for contractors. Before we begin, there is a questions box. Any questions that you would like to ask throughout the course of the webinar, please do. You can ask it through that questions section in your dashboards at any time, and we will endeavour to answer all of the questions today. So, starting with the loan charge, as I mentioned, not everyone on the webinar will be effective, so a short summary of where the loan charge is. Those who perhaps don't know what the loan charge is, although I imagine lots will, this is a tax on loans, or HMRC's intention to tax loans on outstanding tax loans outstanding as at 2019. The intention is to try and remove the advantage of what HMRC consider to be tax avoidance on disguised remuneration since 1999, now amended to be 2010. And we'll talk through the loan charge review that has happened at the end of last year, following a very extensive campaign led by both the Loan Charge Action Group and the Loan Charge APPG, and supported certainly by us, most of our clients and a lot of MPs and other professionals. It's been a big campaign, it's been a successful campaign, and will continue very definitely into the future. The loan charge review has been completed by Sir Amyas Morse, and that was an independent review into the loan charge itself, the legislation and the effects it potentially has on the contractors. The result of the review so far is that loans pre the 9th of December 2010 are no longer in scope of the loan charge. Loans post the 9th of December 2010 are only in scope if an inquiry exists or not enough disclosure was made on the tax return at the time. And the fourth position is that you can now spread your loan payments over 3 years, starting 2018-19, 2019-20, and 2020-21. An additional point that was made on the review, and as a result the response by the government, is that the voluntary restitution payments where people who have settled under CLSO2 will be refunded where the loan charge is no longer determined to apply because the loans were pre-December 2010. Voluntary restitution is where you settled for where you have no inquiry, and so it's a position where the tax is now determined to no longer be due at the moment, and therefore those repayments will be refunded to all people once the draft legislation is amended into full legislation. HMRC anticipate in the summer is when you can start applying for refunds to be made. So those are kind of summary of where we are on the loan charge. Interplaying with that is the tax return, which we'll go on to and talk about shortly next. But for those affected by the loan charge and the loan charge review, we will be holding a webinar for everyone, not just clients, on the 21st of January, which focuses on the loan charge itself, the review and the fallout, and what is expected to come over the next couple of months, over the course of the year as well, in terms of continuing the lobbying and efforts to challenge that. I've put a note down there at the bottom that the retrospection associated with the loan charge has a huge effect on all taxpayers. That's not just contractors, that's not just people who have been affected by the loan charge itself. It's huge, and it has a massively detrimental effect on the certainty of tax and the tax system. On that basis, whilst I appreciate that not everyone on the call is a taxpayer affected, you really should support the efforts to try and reverse change, amend the loan charge as much as possible, because clearly the effect and the retrospective effect and the kind of potential damage to our taxation system and the certainty can be extended into much wider parameters for taxpayers. So this really does need the support of all taxpayers, and most particularly all taxpayers within the contracting community, purely because there is a clear method to trying to tax the contracting industry in this retrospective manner. As I say, there will be a webinar on the 21st of January focusing on the loan charge, so be sure to sign up for that for further information. So moving to the 2018-19 tax return, the deadline for filing the return is 31st of January 2020 at midnight, as always. We've had lots of people asking us, as a result of the loan charge review, whether they can delay their return. The reason for that is the loan charge review determined that the penalties and late filing fees associated with filing your return late for the loan charge will be suspended if the return is filed by September 2020, end of September 2020. That has been confirmed by HMRC to only relate to matters associated with the loan charge. So that does not include any normal income, any property income, or any other income that you've received. And the tax return should be continued to be filed as normal for those points. You should not expect to get a reprieve from late payment penalties and late filing penalties for normal aspects of your return if you file by the end of September as per the loan charge review instructions. Typically 1/10 of the returns filed on the 30th and 31st, so that is very characteristic of the tax industry, leaving filings as late as possible, both understandable and should be avoided where possible. our advice is always to not leave it to the last minute. Try and get the information in as soon as possible. Lots of people will have been waiting for the review and will be wanting to understand the outcome of the review. That has confirmed that you can file by September, but that does not affect your normal income. So carry on, file your tax return as normal, get everything in as soon as possible, and then try to understand your position on the loan charge. Delay because of HMRC system failure, typically because on the 30th and 31st, that level of returns are filed and there is a crash sometimes, not always accepted as an excuse. So don't risk a penalty, just get your return in as soon as possible. Moving on to Brexit, that word we've all become all too familiar with over the past couple of years. Clearly, Brexit brings about a number of considerations for contractors, and this is a hugely concerning time for contractors, which is entirely understandable. Brexit, IR35 extensions, loan charge review, all of these things compound the issues of what is certain anymore. Around 45,000 UK contractors live and pay taxes in the UK but work in mainland Europe. With our trade deals removed in time, what will the result be on those who work in Europe? What will the result be on their IR35 status? Who determines? All of these points will need to be considered. Clearly, IR35 legislation is clear on the reforms and how that those extensions determine the assessments to be carried out, and we'll be running an IR35 focused webinar shortly as well, and that will go into much more detail on the IR35 side of things in due course. But there are important things to keep in mind with regards to Brexit. There will be a transition period from the date we leave. It's expected to be 11 months, and that will determine that people can still work and remain working, and we will be subject to the EU rules, but will not be within the EU, considered to be in the EU. It is possible for EU companies to retain UK contractors for this period, and it will clearly be possible for EU companies to retain UK contractors post that period. Lots of people work for EU companies but are based in the UK, don't need to go over to those countries, and so things will continue as normal. There will remain uncertainty though, and where you can be as clued up as possible on your company, on your PSC, whether you're operating in a consultancy arrangement, you have a statement of work in place, all of these hiring decisions will be considered by companies in due course. Brexit will come into that, but so too will IR35 restrictions. And the clearer you can be and the more complete you can be in your approach to IR35, your understanding of your company, your understanding of your work and how you contract is going to make you more attractive to end clients who are suffering from that uncertainty. So the overriding message there is get acquainted with all the rules, regulations, understand them inside out. There are many, many companies offering free consultations, webinars, newsletters, everything, including ourselves. Feel free to come and talk to any of our tax team for free, just to understand the position. It's important you understand where you are, and it will definitely help in the prospect of uncertainty of Brexit. Budget 2020 is the next position. Budget's been announced for March the 11th, 2020. Some points we may see. We anticipate potential changes and or the removal of entrepreneurs relief, which we will touch on later on in this. That is becoming a real possibility, even goes so far as to say it might be a probability. Do you agree, Tom?
I would absolutely agree with that,
yeah.
And we'll cover that and why a bit later on.
there may be some minor adjustments to IR35 as part of that budget. I think the government probably consider the announcement of the review to be sufficient to cover off any issues they have around IR35. Clearly, the industry as a whole strongly disagrees with that view, and there will be continued lobby efforts to try and change that position. But then we may see some minor adjustments to IR35 legislation through that budget, but perhaps unlikely. We'll start to see some of the Tory pledges coming through in their effort to be a little bit more transparent, in line with their pledges pre the election. That may see an increase in the threshold for national insurance, and clearly that's going to help people to a small degree, but a very small degree, I would suggest. There's going to be potential for increased rights on 0 hours contracts, although not a lot of contracts are built on that, and possible changes to some of the more generous tax reliefs, such as pension contributions. And clearly that affects anyone who is trying to mitigate their tax liability through pension contributions. So you need to keep a close eye on that and understand the new rules around that as you start to plan towards the end of this tax year and moving into next tax year, clearly. We are unlikely to see significant changes in tax rates. We anticipate those largely staying the same, and as above, we're unlikely to see significant changes on IR35 legislation, although the lobbying will continue and pressure will continue to build on that, I anticipate. Moving on to the IR35 review and its implementation. The IR35 review was intended to be a substantive review of the legislation and its application. What has clearly transpired is that that's not the case. It is a review into the implementation of the legislation itself. It's not a review of the legislation. It's a very difficult play on words there to narrow down that the scope of the review so much to render it largely ineffective. The extensions previously into the public sector have largely been considered successful. It's recovered some tax due from entities like the NHS, and as a result, I think perhaps the government can see it working and therefore want the same to apply. So even if it's successful implementation in the public sector, does not by any stretch of the imagination mean it's going to be the same level of success within the private sector, which will be a completely different beast. But I would also expect those roundtables and the review and implementation to be somewhat HMRC, making everyone feel, or the government making everyone feel like everything is fine, and talking to key stakeholders about how they should do it, rather than HMRC and the government being in listen mode for that. So I think lobbying will continue, and there are clear changes that have to be made to the IR35 legislation for it to be any level of effective for the private sector, and hopefully those changes can be made in due course. The practical effects, clearly, and these should be shown to your MPs, should be shown to your kind of public profiles on LinkedIn and everything, showing the effects as a potential decrease in available contracts, clearly as uncertainty reigns throughout the industry for the freelancing for contractors. Definitely a decrease in available contracts outside of IR35 as we see more and more large companies blanket assess their workforce to include to make everyone inside IR35. There is, however, a good opportunity for those who wish to explore alternatives to traditional working methods for contractors. Those include statement of work contracts and, where possible, we're speaking with a lot of people who have a number of contractors that they work with very commonly, and they bring in to administer and finalize work. Where you can build a small consultancy arrangement, then clearly you take yourself outside of the scope of the IR35 reforms. That in turn, both that and statement of work contracts remove considerable risk on the end client and agencies, and take it back to considered working outside IR35. Those are two methods or routes that we are exploring a lot for a lot of clients, and should be considered where practical. Clearly, the effect of that is that it's not enough just to build a consultancy company and work normally. It's not enough just to draft a statement of work and carry on working. Serious and fundamental changes to the working practices and how the contracts are run are going to be needed, and as part of that, a sensible and strategic framework around how you work, how you engage with other companies, how your company engages with other companies, and what happens through the course of the engagement is going to be imperative. So take some consultancy again, listen to people in professional industry, go and speak with the companies offering free consultations, just gather up your information and understand where you are on that. IR35 is going to be a big changer, and it's important to take that seriously.
I think it's worth saying that any government policy or Treasury policy change clearly comes with compliance issues for the revenue. It's no good changing the legislation if they're not going to police it. So you can expect an increase in IR35 inquiries for those that are continuing to work outside IR35. And what Reece said there is really important. It's not going to be what the contract says. They're going to look at, what do you really do? What is the practical way you work? And they won't just interview you, they'll interview the end client and other people you work for to get the real nuts and bolts of how you're operating. So please do not think that just a piece of paper is sufficient to cover you. It's not.
Absolutely. Clearly, as a result of those, if those can't be taken into effect, there may be a possible need for an umbrella and a reduced need for your personal services companies, which clearly you need to conduct a review of the legitimacy of your personal service company moving forward, whether you need it. And as a result, we do need to consider entrepreneurs relief as a sideline to that. Where your limited company is no longer required, you can consider members' voluntary liquidation. This is going to be largely dependent on what assets your company holds and what you want to do with it. There is also a consideration that dormatizing your company while you get to grips with the IR35 changes will be more sensible. That's particularly because of the phoenixing rules, that you can't shut down a limited company and then start up another one within about 3 years doing practically similar work. So if you're considering a liquidation event for your company, it needs to be because you're moving into permanent work or because you're doing work of a largely different type. And by largely different, we mean probably a different industry. The reason we're raising this, because entrepreneurs relief we consider may be abolished / changed considerably as a result of the budget. There's a lot in the market suggesting this. We suggested it last year, kind of towards the end of last year, and I think since then there have been more and more indications that it may happen. So you do need to prepare for that because it is a generous relief. The effect of entrepreneurs relief on an MVL is that there can be the distribution from the limited company is taxed at a 10% capital gains tax rather than income tax, for example, or dividend tax for you taking it out before. The other consideration, other than it in its potentially short lifespan, is that where you use entrepreneurs relief and you are liquidating your company near to the new tax year, you can have two separate distributions, one pre the end of the tax year, one post the end of the tax year, whereby you take the benefit of 2 years worth of your basic rate band for capital gains tax. So there is a sensible position there in terms of tax planning where Entrepreneurs Relief applies to your circumstances. The parameters around where Entrepreneurs Relief applies are fairly straightforward. Do your research. We've written a couple of blogs and articles on it. Get in touch if you want to discuss it on a no obligation basis, obviously, but Entrepreneurs Relief is something you should consider and is potentially something which is finite in its lifespan. So think about it soon is the message. So that's all we want to discuss today on the webinar. It's a very short kind of generalist view for the webinar of the year. As I mentioned, our follow-up webinars will be much more detailed and in-depth and more focused on tax considerations. This is just a fairly straightforward, easy one for returning in the new year and some contemplations. We will be updating these webinars over time, updating the considerations as legislation comes through, such as the draft legislation for the loan charge review, and we will of course keep all those updated on our newsletter. You can sign up to on our website with further information as we go on. We have no questions currently, so unless there are any new questions coming in now, we will end the webinar today, and thank you all for your attendance. This will be shortly published to our YouTube channel as well, so if you want to listen to it again, which I doubt you will, you can do so there. Thanks very much all.
Thank you.